Okay, hello everybody. Welcome to Korean Lanta Mentorship. So just another Velocity Banking review video and also an excuse to put Transformers on the thumbnail. So what we're going to do today is transform our cash flow instantly with using something called a line of credit. In fact, I'm going to get a British AI voice to finish my sentence of what Velocity Banking is.
Velocity banking. It's more than meets the eye.
Yes, it is. Okay. So, all velocity banking is, again, it's a debt payoff strategy using your line of credit as your main operating account. And there's really only two things that you need for it. It's number one is a budget. We have a budget. We have income, we have expenses, and we got some debts, right? We got three credit cards right here. Let me put three, two student loans, and hopefully we went to professional school with this $100,000 student loan, which is why we're making some decent money, two cars, and a $260,000 mortgage with just general expenses of $2,500. So the whole goal of this is to eliminate all of these debts, right? And we have our fixed expenses that are always going to be there, so we're not eliminating this. We need food, gas, insurance, so we're always going to spend money for that. And number two is a line of credit as our main operating account. So what is a line of credit? All it is a financial tool where you can borrow money, pay it back, and then use it over and over again. So one thing I do want to mention is that in order to get a line of credit, you have to get it before you need it, right? Because banks don't lend money to people who need it. And so when people are in a financial pitch, let's say they're making good money, but they don't have that much left over, especially making $8,000 a month, right? That's not common income. But one of the things that I really want to emphasize is that, let's say you have $10,000 of income and you have $10,500 expenses, and your savings rate is like negative 500. You're in a much better position than someone who makes $3,000 a month and has $2,500 expenses, right? And if you've ever seen the presentations before or these videos, you've known that, and I've shown that to you. And so some people, they have these limiting beliefs that they can't make more money, but really making more money, even if you're negative cash flowing, is you put yourself in a much more advantageous position. Now we're going to assume here that we're at positive $500 of savings, right? And again, even positive $500 is a stretch for most people because most people are broke. And one of the reasons most people are broke is because they have their money allocation in an inefficient manner. And we're going to help do that or eliminate debt and put ourselves in a much more efficient position with the help of a line of credit. So a credit card is a line of credit. We have home equity lines of credit. We have personal lines of credit. Again, it's a financial tool where you can borrow money, put it back, and then use it over and over again. But the thing is, with credit cards, they're just a little bit more inflexible, right? With a HELOC or home equity line of credit or personal line of credit, I can use it to pay anything, right? I can use it to pay credit cards, student loans, auto loans, but with the credit card, I can't do that unless I'm, paying a 3% fee, almost a 3% fee to Plastique.com, right? But let's just assume we have a huge line of credit. In fact, some people complain, they watch these videos, like, who has lines of credit like that laying around? And I'm just like, well, me, because again, I studied this stuff. I took classes from Renatus, and people were like criticizing me, like, well, you would spend, $2,000 on, education, get free online. And here's the thing, here's what people don't understand: when you pay attention. When you get things for free, you don't pay attention, right? So I paid like first 2 grand and then 20 grand for online classes, and I learned the secrets of getting credit, which is banks don't lend money to people who need it, right? And so you can see here, I got a $15,000 line of credit available to me, right, at a 15% interest rate, and I haven't even used it. I probably got to use it because hopefully I don't want them to shut it down. And then look at this one right here. Wink, wink. That's a pretty decent line of credit, and we'll assume for today's video that we'll have access to a $280,000 line of credit. That's a spicy meatball, right? All right, so now we're going to assume two things. Number one, we make the same income, so we're about efficient allocation of our money. So, a lot of people think when there's the situation, oh my goodness, I need to make more income, right? Like more income. But if it's great to make more income, but if you can't use it wisely at this level, what's a 10 grand gonna do for you? You're probably gonna be at a, still at that $500 savings rate because of Parkinson's law of money, which is that the more you make, the more you magically spend, right? So we got to figure out how to make our income work for us regardless of the level. Okay, so now what we're do is we're going to say zero savings because that's how what we do with velocity banking. So if you're doing this right, after every single month, when you see your checking or savings account statement, it should be close to zero, maybe a penny at most, right? And so what we're going to do is we're going to re-engineer our expenses. Whoopsie. Re-engineer our expenses, and then we're going to have something called cash flow, right? So it's C2 minus C3, income minus expenses, and then you'd be like, wait up, wait up, wait up. These two numbers are exactly the same, and I'm just saying, wait, let me finish, okay? Let me finish. So what we're going to do is we're going to make our line of credit, our 280 grand line of credit that's unrealistic for most people because they try to go to a bank and get the money before they ever need it and not realize that banks don't lend money to people who need it, right? But let's assume that we have a $280,000 home equity line of credit available, right? Well, let's go ahead and transfer some debt. We got these 3 credit cards right here. So that's 43 grand. 5 plus 8 is 13 plus 30 is 43. So let's go ahead and just transfer that. We don't have to use the whole line of credit, but the higher the limits, the better usually. Okay, and then take a look at this. Okay, just by simply transferring that debt, we haven't eliminated it. This goes to zero, this goes to zero, this goes to zero, and we went from 500 to 2,000 in one swoop. Oh my goodness, this is so easy. All right, so now let's go ahead and calculate the next month's balance, which is based on the previous month's balance, whoopsie, previous month's balance plus the previous month's interest minus our cash flow number, right? So what's our cash flow number? It's this 2 grand right here. So let me fill it in right here. So 2072.68, right? And then what we're going to do is we're going to use this average daily function, or not average daily balance. What am I talking about? Where'd it go? Right? So there's this thing called the average daily balance right here, average, and then we're gonna multiply it by the interest rate, which is 10% right here for a HELOC. Actually, for this $280,000 HELOC, it's actually 8.5, but we can make it work with 10, right? So let's go ahead and divide it by 12. And then you can see for that month, we pay about 340 grand, or 340, not grand, dollars, $49 of interest. And then we just rinse and repeat. And so what's the actual velocity banking strategy? How do we get from here to here? Well, once we have made our line of credit as our main operating account, what we're going to do is put this entire $8,000 into this $43,000 balance and then take our expenses of $5,900 out, and then after every single month the balance is going to go down about 2 grand. Now that 2 grand is so much better than starting out at $587. So even with the interest, which is only about 300 something, man, we're winning, right? All right, so let's go ahead and do that and just copy and paste, and just wait until the numbers become red, and then that's when you've paid off the debt, right? So let's go ahead and do that. And now it's 23, right? So 23,000, or not thousand. It's early for me, so I'm just mixing up my words. So at 23 months, that's when all that debt is paid off, right? So now we got to record our milestones. At 23 months, we paid off 43K. Bam, blam, right? And then now what we got to do is we got to pay off all these other loans, which is student loans, auto loans, mortgages. And you might be wondering, why would I put this, 5% or 4% mortgage or loan into a line of credit when the line of credit is like 10 to 15%? I mean, take a look at this right here, or no, right here, it's 15%, and this one is like 10%. Why would you do that? It's because when we create enough cash flow, the interest rate is relatively, I don't want to say completely nullified, but it doesn't matter as much. We'll say that, right? And so out of these, how do you know? Let's see. How do you know which ones to pay off? Do I pay off the mortgage first because it has the biggest balance? Do I pay off this 6.5% because it's the highest interest rate? I'll tell you what, the formula that I like to use is something called the cash flow index. So we're not really thinking about interest rates, even though they do matter and they do affect the cash flow. But there's a simple formula where you take the statement balance divided by the monthly payment, and then it'll give you a number. So let me just show you right here. Okay, well, not right here. Where am I? I'm okay in my nifty loan calculator, right? So basically, I put in the balance, the interest rate, the loan term. It spits out a payment, right? And then it spits out something called the cash flow index. And so the lowest number is the one you want to pay off first, right? Okay, because, well, let me just show you this. If I pay off this 22 grand, I get $430 in payment, right? Whereas if I pay off this 260 grand, right, I only get $1,000 of payment. So which one gives you more bang for your buck? Well, it's this one with that lowest cash flow index. So what I'm going to do is I'm just going to move this into the line of credit, right? So let's go ahead and do that. And again, you could just attack one loan at a time. Make it easy for you, right? Make it easy. Easy is where the money's at. So this 22 grand, let's just move it into the line of credit, and let's go ahead and do that. And then what we do is wherever we left off here, how many months was it? This was at month 23. What we got to do is figure out what the balance of these are at month 23. And the lower the number, especially below 50, if you know how the cash flow index works, that you want to put those into the line of credit. So let's say instead of just moving one auto loan, let's move both of these auto loans, and let's go ahead and copy these values here and then paste them right here. And let's go ahead and do that. And then what is the sum of these two numbers, right? So sum and G25 to G26, right? What's the sum of those? Oh, not 26. It's got to be G26. Okay, so now plus 30034.68. Okay, and so if we move these two debts to the line of credit, guess what happens? We get a lot of cash flow back. So you see these two auto loans, right? The almost $800 in payment. Well, this goes to zero and this goes to zero. And oh my goodness, how do we go from almost 2,000 to 3,000, right? So now it's 2967.12. And what we got to do, let's go ahead and copy this number, right? And I'm going to go ahead and copy and paste. And now the next one right here, it's 2967.12. And then what we do is just copy and paste this. And yeah, let's go ahead and do that. Copy and paste, right? And then we're going to pay off these two auto loans at 34 months. 34 months. Oh my goodness, that is so easy. All right, so let me go back here, right? And 34 months. And so now the next thing that we got to do, right? Whoopsie, I'm clicking all over the place. But the next thing that we got to do is now focus on the other loans, right? And then so let's go here. So this is going to be 0, 0, and then we don't have to care about these anymore. And then what's the balance over here, right? So now if we take a look how long it took us, it's 34 months. And so 34, 34, 34, and then we see that the cash flow index is 72, right? 72. And so again, if you know anything about the cash flow index, it's basically anything below 50 you want to pay off. But we can do 72. But take a look at this mortgage, right? 222. So if it's a really high number, right, it basically means that it's gonna take a lot of effort to get this $1,000 back, right? Which is why we don't put it in the line of credit, and we usually don't replace a mortgage with the line of credit, right? Very unusual to do that. So let's go ahead and move this 30 grand into the line of credit. So we'll do that right here, and then I'm going to move this 30 grand right here, and then right here. And so let's go ahead and do that. So it's going to be plus 30611.98. Okay. All right, so we did that, and then if we go back here, then this student loan, we get an extra 420 something dollars back, and now we're at $3,339.38. So let's go back here, and then now what's our new cash flow? Let me go ahead and copy and paste this. So again, it's 3391.38. All right. And then now I'm going to copy and paste this here, and we just do the same thing over and over again, right? And over again. And then 43 months, right? So 43 months, we paid off that student loan, okay? And then now we go here, and so this is now 0, right? And then at 43, that's when we move it to the line of credit, and it's about 68 grand, but 68 grand to get $1,000 back, right? So now let's go ahead and move this here to 68 grand, and then move that, so plus 68,657.47. Okay, and then for moving that second student loan, we get that $1,000 back, and we're pretty much at $4,000 of cash flow, right? This is where it's at. We're applying all of our money into that line of credit. All right, so let's go ahead, copy this, paste this here. All right, so now let's go ahead and copy this here, and then we're going to subtract this cash flow, which is 4403.83. Okay, and then now we just keep going and going like the Energizer Bunny, if you know what that reference is. And then now let's go ahead and pay these off. So this is going to be 60, right? So 60 once we paid off. So we're at the 5-year mark, right? 5-year mark of paying off our student loan. And so now let's go back here. So this is now 0, and then at month 60, we see that the balance of the loan is 231. So we paid off about 30 grand in the loan. So you see the original balance is 260. You see the current balance is 230. And then take a look at this. We paid 36 grand in interest, right? So it's like 1-to-1 ratio, and that's at a 3% interest rate. So a lot of people, they see this and say 3%, that's such a cheap interest rate, but it's really, you're paying 50% of the total loan. In fact, if I do 360 months, which is 30 years, right? How much interest did we pay? 134 grand for that $260,000. Now, I know a lot of people say, well, I could just invest in the market, but market returns are not guaranteed. And most people are not patient investors, right? In the long run, you'll make more money, but most people are not that patient. Okay, so let's see, $231,000 is where we're at. And again, you might be thinking, should I replace this entire mortgage into that line of credit? And the answer, probably 95% of the time, or at least 100% of the time, is do the math, right? So what we can do is just kind of chop up the loan into pieces, because unless we have a line of credit that's 3% or lower, and we have a huge line of credit at 8 or 10% at 280,000, yeah, we could move it. But if you replace it, usually it's not as effective as you just chop it up into little pieces, also called chunking, and then just doing small chunks, moving it to the line of credit. So for example, instead of moving the whole 231, you just do like 221K, take out 10K, and then move it to the line of credit. So what's our cash flow right now? Did I fix it? All right, so yeah, so our cash flow is still the same, because the cash flow only gets recovered when you move into the line of credit. But let's go ahead and just kind of demonstrate what I mean by that. But let's say here, you move 10 grand of the loan to the line of credit, and then bam, it gets paid off in 2 months, right? Whereas, here, even though 60 months, we're just paying that amortized payment, we paid 36 grand in interest, and it took us 60 months, and we paid 30 grand in principal, almost, right? Whereas we did the other way around. It only took us 2 months to pay 10, so you multiply by 3, that's like 6 months to pay 30 grand rather than 60. So uh, again, so that's what we'll do for the mortgage. And then we just rinse and repeat over and over again. So put another 10 grand here, and then just rinse and repeat. And then we should pay it off relatively quickly. Now, luckily, we have this cool thing called the Velocity Banking Calculator. And let me whip it out. Let me whip that thing out. All right, so let me go ahead. Give me 1 second. Okay, and now it's going to load. And let me go ahead and fill in the numbers right here. So I'm going to switch screens. And all we got to do is fill in that loan information. That's the cool thing about this Velocity Banking Calculator. Again, I got it from Renatus, and some people are like, where do you get this from? If you're a Renatus student and you register, in full disclosure, I'm an independent contracted marketer, meaning I sell this stuff and I get commissioned. And you might be like, well, your agenda is to make money. And let me tell you something. You go to work with your attitude and you let your boss or whoever tell you, well, you're just here to make money, right? See how that works out. So let's go ahead and just put in the information. And so what we're going to do is just put the original balance is 260,000. And what is the current balance right now? Let me take a look at the other screen. It is 231. Whoopsie, 231,156 point 54. Okay, and that's a really low 3% interest rate, and we assume that we got it when the interest rates were really low. And then the payment is 1096.17. 1096.17. And what is our income? Our income is, let me just kind of take a look, $8,000. Okay, so $8,000. And our expenses is 2,500. So let's put that in correctly. And this whole chunk amount thing, all it is how much you're moving to the line of credit. To be honest, like it doesn't really matter that much as long as it's a small amount around your paycheck. What really matters is the spread right here of cash flow, right? Because let's assume that, and take a look here, 3.8 years and 14 grand in interest. But let's see, I do $10,000 chunks instead of 9,000. What? Couple $100 more, and realize because you're moving it to a higher interest rate line of credit, yeah, it is going to cost more, right? But again, it's going to make a minuscule difference, and the more you put, it's the more the trade-off is convenience. That's really what it is. And so, you might be asking, like, why do you move the principal into a line of credit rather than directly overpaying it? Well, let me tell you something, people or friends. Being able to directly overpay your mortgage is the default that nobody ever does, because if everybody did it, almost all mortgages would be paid off in like 7 to 10 years, right? But the thing is, a loan is a one-way street. It's a one-way street. So if you ever overpay that loan directly with your cash, it's gone. Whereas if you do it this way, it's almost the same thing, except that you prevent something called the segregation of income. And if you've maximized your cash flow, this is an easy way for you to figure out, well, not even figure out, to overpay your mortgage. It really is. Because think about it. I have to exactly know how much will go from my savings into that mortgage every single month if I directly overpay for my savings, because I can take that money out. And if I use, let's say, some sort of a line of credit as a backup, I'm going to be engaged in segregation of income, and that's a no bueno, right? And I've gone over segregation of income in other videos, but let's go ahead and just compare two things. Now, some people might say, wow, get a first lien HELOC and replace your mortgage. And you might have like a really cheap 3% mortgage, and let's go ahead and replace our mortgage to line of credit. And take a look at this. It's 4.4 years and 55 grand of interest. So I don't know about you. Do you want to pay 14 grand of interest at 3.8 years, or 4.4 years at 55 grand of interest? You tell me, right? So that's why the chunking method is superior. Just chop it up into little pieces. You'll be fine. Plus, you don't have to use that whole line of credit because, what if you need emergencies? What's your savings account, right? So now you see that 3.8 years, and let's just go in, and we're going to go here, and all right. So now I didn't even write the milestones correctly. I skipped all this, but whatever. We'll just, all right. Um, 3.8 years, and let me just kind of go here. So 60 plus 3.8. So this, all right. So how long did it take us? 60 months divided by 12 plus 3.8, right? And that is 8.8 years debt free. And let's sum up all of this debt. So this is 5 plus 8 plus 30 plus 140 plus 24 plus 22 plus 260. Wabam, $489,000 of debt free, right? So definitely debt free. So good times. All right. Well, okay. Well, that's it for today. So again, we transformed our money from our savings to this huge cash flow. In fact, this should be zero after 8.8 years. And now we got 4,403, no, 5,500. Look at that. If I have the Velocity Banking Calculator open, the system gets slowed down because, it has all these calculations in the background. It's one of the most advanced Excel spreadsheets I've ever seen. It's kind of crazy, right? I've never seen Excel slow down in making this income minus expense calculation. But yes, we transformed this by a multiplier of 10 from 500 or almost 10, 587, or actually even more than 10 now that I think about it. But whatever. All right, so $5,587 to $5,500. And yeah, with the help of a line of credit. And again, don't bring your negative energy, right? Like if you right now, if you're thinking right in the moment, oh, I could never do this because I can't get a line of credit. Get educated. Learn about credit, learn about real estate, learn about how all this stuff works. Because again, banks don't lend money to people who need it. And so when I look at this sweet $280,000 home equity line of credit, I'm like, ooh, if I need this, when I do need it, I'm never gonna get it. But I get it when I don't need it. And, I don't know. Maybe I could do a real estate deal, down payment, or seller finance and then use this to cover my costs and then help me do velocity banking. Possibilities are endless when you have credit available, but you have to also know how to use it correctly because it's kind of like a loaded weapon, right? That's really what it is. Okay, well, that's it for today, everybody. Have a great day. Velocity Banking Friday. So hopefully your day isn't too stressful, and we will speak next time.